Hi, hello, welcome to all. In this video we are going to discuss about pricing decision in SCPM chapter. Okay, what is there in this pricing decisions? Why we'll take the pricing decision? In last chapter we have seen the transfer pricing, that is we have calculated the maximum price and minimum price, that is maximum price or minimum price whenever they are transfer in between the inter department. But in pricing decision we will calculate the which is the best price, which is not a maximum price, which is not a minimum price. We will calculate here best price, that is profit maximization here. Okay, pricing decision is this is a structured approach. Here theory of price maximization model, price under different market structures, and pricing policy principles of product pricing, price sensitivity, price customization, price adjustment policies. And in case of pricing methods, competition based, cost based, value based. And whereas price in periods of recession, price below marginal cost, pricing of services key issues. Next, in case of pricing strategic pricing of new product, where skimming penetrations, pricing of product life cycles. Here skimming and penetrations are two. When you have a producing a new products, we will use these strategies. We will see in clearly in their case. Here what pricing decision means is the one of the most crucial and difficult decision that a firm has to make, such a decision affect the long term survival of any profit oriented enterprises. So it will affect the long term oriented, and here the profits, here the profit will depends on pricing what you are putting for the your products. Okay, what is the theory of price? Theory of price here, this is a basic microeconomic theory. Here it defines optimum price. Optimum price has that price which yield the maximum profit, that is which we discussed in starting only. Here we will not calculate any maximum and minimum. Here only the price which yield maximum profit. We bothered about only the profit, that is excess of total revenue over total cost. We will not calculate any maximum or minimum. Thus here the basic assumption of the pricing theory is firm's main objective is to maximize its profits. It is the main objective of the firm, and it also assumes that the firm takes into consideration the position of demand and cost functions that the firm produce one product. Here the firm sells unlimited number of units, where total revenue line will strictly arrow TR is equal to MX, where TR is equal to total revenue line, M is equal to quantity of units sold, X is equal to price per units. For example, they provide one example, that is if a firm pricing of a product he has under, that is 20 units, and okay 20 units 4 rupees per unit, 21 units 3.9, and 22 units 3.38, where your volume was increasing, quantity was increasing, or demand was increasing, your price will automatically decrease. Here quantity was increasing and your price automatically decreased. This is the normal marginal structure, marginal utility. Normal theories also explain that where your demand was increased, then price will be decreased. So quantity increasing, price will be decreasing. So and so your total revenue will be also increased, and additional total revenue will also increase. That is the case here. Next, here they put that in graph format. Here what is there, your cost and revenue here provided, and your cost and revenue, and Q was provided, where your total cost, and it was going like your total revenue, this is your total revenue, and your total cost, this is your total cost. And here we will, where intersect is there, no, there is marginal cost, and your average revenue, here where it interacted, it is the marginal average revenue for your product. Though so for this we will know the where demand was increasing, your price was decreasing, and your revenue was increasing. What we want is the profit maximization, where your profit will be maximized, which place. So we will identify this based on profit maximization model. Here the profit maximization model, a level of output where marginal revenue is equal to marginal cost. We'll identify this. Where marginal revenue is equal to marginal cost. What is the marginal revenue? Marginal revenue means it is a addition in total revenue by selling one more unit. Your total revenue regularly 100. You are selling totally 100. If you sell 101, additional 1, that is what is the margin of that additional TR, additional total revenue by selling one more unit. If you sell the one more unit, then what is the revenue and what is the cost? If equal to the cost, you must count that marginal cost and marginal revenue. Next, here they provided the one formula that for that calculation profit is maximized based on P is equal to A minus BQ. P is equal to A minus BQ. Here P is equal to price, B is equal to slope of the demand curve, where B is equal to P by Q. Already P is there, so change, that is change in P and change in Q will be the slope and Q will be the quantity. Price, P with price, Q will quantity, and B, small b, will change in price divided by change in quantity. A will be price at demand is 0. If demand is 0, what is the price? Here we will calculating where demand is increasing, price will decrease. When demand is 0, what is your price? When demand is 0, what is your price? We are calculating, that is the profit maximization state. What is the marginal revenue is equal to marginal cost. Here marginal revenue is equal to formula will be P is equal to A minus 2BQ. P is equal to price, A is equal to price at which demand is 0 minus 2, B is equal to change in price divided by change in quantity, Q is equal to quantity. For example, they provided one example. Here Aditya Heavy Engineering Limited produces its only product A. It is producing product A. Okay. The manufacturer of unit A variable cost will be 2,22,000. This is variable cost. It was incurred 2,20,000, and market research has indicated that selling price will be 5,10,000. No order will be received. Okay, no order will be received means 5,10,000 is where the price at which demand is 0. Even though there is a demand is 0, the price will be 5,10,000. That is small a value. Small a value will be, this is small a. Okay, and next this is 2,20,000 will be the marginal cost. How much you are incurring, that is your marginal cost. We require for profit maximization, marginal revenue is equal to marginal cost. Next, what is the information next provided? But the demand for A7 will be increased by 2 units. So what is there, these 2 units? Marginal revenue. What is the marginal revenue definition? Addition in total revenue by selling one more unit. Here we are selling 2 more units. Okay, with every 5,000 reduction, that is 5,000 was reducing here, so quantity was changed to 2. The change in quantity will be 2 and change in price will be 5. So 5,000 divided by 2. Next, quantity in the unit selling price below 5,10,000. So we required now what is the quantity. Next, to determine, we have identified that marginal cost and small a and change in quantity and change in price. Next, we will calculate what is the quantity. Next, to determine the unique selling price that will maximize the profit AHL, we assume that selling price will be P and quantity demand will be Q, and marginal cost they provided already 2,20,000. Price equation will be P is equal to A minus BQ. Already we know the A value, that is 5,10,000, and change in quantity will be, change in price will be 5,000, and change in quantity will be 2 into Q. We don't know the P value and we don't know the Q value. Next, revenue they provided. Revenue was irrelevant here firstly, and marginal revenue is equal to A minus BQ, where 5,10,000 into 2. Marginal revenue formula will be A minus 2BQ. If you want price, it will be A minus BQ, but if you want marginal revenue, it will be A minus 2BQ. It is the different for it is the for price, it will be the marginal revenue. Next, marginal revenue. From marginal revenue we will calculate the quantity. Why? We will know that marginal revenue is equal to marginal cost in max profit maximization period. So we know the MR is equal to MC. We know the MC value, and we will find out the MR value. What is not there? Only Q is not there. So by substituting that values, this is MC, and we already this know 5,10,000 A. 5,10,000 will be the cost minus 2. 5,000 into Q is equal to 2,20,000, where Q is equal to 58 units. Now the quantity was identified. Now price will be calculated. Price formula will be the what is the price formula? A minus BQ, whereas P is equal to A minus 2BQ. Now we clarified Q is equal to 58. So P is equal to 5,10,000 minus 5,000 divided by 2 into Q, where 5,000 divided by 2 is equal to 2,500 and 58 units. Now, so profit will be 3,65,000 at selling price, where the selling price is 3,65,000. Then your profit will be the maximum. This is the profit maximization model. MR, marginal revenue, is equal to marginal cost, and price will be A minus BQ, and marginal revenue is equal to P minus 2BQ. Next, price under different market structures. If you have a different market structure, how can we find out the perfect market? Here we will see directly they provided one example. Here, which is the market providing the your increasing ad cost. And for example, here Aditya LLP produces a product X. The market for the product X is competitive. Okay, the prevailing market price for the product X is 40 rupees. Okay, 40 rupees will be the what they providing marginal price. So okay, the following table presents marginal cost and profit for the product X. Okay, here we will find out where is it maximization. Where is your maximization? Maximization will be marginal cost is equal to price per unit. Next, here what is the total revenue? Total revenue was increasing 40. So at the 0 units there is no revenue. For 1 unit it will be the profit will be 40 units will be 40, and for 2 units 40 into 2 and 40 into 3, add 40 into 4, 40 into 5, 40 into 6 to 40, and total cost will be, for total cost they provided for 20 rupees, and for profit will be, it will be only cost. First time you are incurring only cost. Next, first time you are incurring cost, and for this we will calculate what is the marginal cost and what is the profit. And here total cost, if you got the total cost for 1 unit 30 rupees, here we will see, we will take this is A, this is B, and we will have this is A minus B 40, sorry, wrong. Here profit will be the A minus B. Here profit will be from cost. From cost we will see where is the total revenue minus total cost will be the profit. Now what is this marginal revenue? Marginal revenue will be the difference of total cost. What is the difference of total cost? This is 20 minus 30 minus 20, it is 10 rupees, and 50 minus 20, it is 20 rupees. 85 minus 50, 35 rupees. 125 minus 85, 40. This is the case. Here provided that marginal cost, we will calculate the marginal cost, and we will got the profits. Profit, how will you get the, from total revenue you will deduct the total cost, you will get the profit, you will get the profit. Marginal cost will be the difference of total cost, difference of total cost. Okay, for this what we will get now, for here at the product, at the units 4, your total revenue will be 1,60,000 and your total cost will be 140, 125, and here it will be increasing trend, and here the increasing trend was stopped at here. So it is the case where the stop is started. This is the case. The marginal cost of producing 4 units is equal to the price per unit. Price per unit, what is the cost at the 4th unit? Thus, Aditya LLP can maximize its profit at 4th unit level. Its profit will be maximized at 4th level. For incurring, you are incurring the cost and you will get the maximum revenue, maximum profit at product 4 at 4th unit level. Next, monopoly. What is this monopoly? Monopoly is market condition where there is only one supplier is there, that is producer of homogeneous product. He is the ruler, he is the king, he is the minister, he is the police, he is the theft. That is only the one person ruling, that is monopoly. There is no substitute, there is no, they have many buyers, they have no substitutes, many buyers, only one supplier. Here monopoly is a firm, is a price setter, he will set the price and it can fix any price, but here also pricing is done take elastic of demand of for the product it into consideration. That means through the seller, producer can fix any price, but it will be go the for the price where demand of the product and consequent profit will be maximized. Next, monopolistic competition, where if you are a monopolistic competition, here large number of firms producing similar but not identical products. This is monopolistic competition. Here there is a limit to the growth of competitors where excess profit earned by monopolistic situation to attract new competitors. Next, oligopoly. Oligopoly means where the market structure where there are few firms producing or selling homogeneous or identical products, and they will come together and they will talk together and they will have mutual independence, mutual interdependence, investments and production process, advertising and sales plan. They will come together and they will talk and they will decide the price. This is oligopoly. Here oligopolistic firms where determining the price of its product consider not only the demand for the product but also the reactions of the other firms in the industry to any actions or decisions. They will form in a community way and they will decide the rate. Next, if a firm does not follow or adapt its pricing policy is consonant with its competitor, the shift in the sales will be sensitive. That means demand will shift toward the lower price. Next, thus each firm will study the potential reaction before increasing or decreasing the selling price. The firm in oligopolistic market maintain the price of the product either by closely analysis of each other behavior or by means of cooperation and collusion. Here pricing strategies, oligopolism. What is the pricing strategy for oligopolism? Here pricing will be predetermined pricing, keeping price artificially low and often below the full cost of production. They may also operate limit price strategy to discourage entrance, so which is also called as entrance volume. Here they will what do not even though their cost is high, even though their cost is 10 rupees, they will kept to for 8 rupees only for the sale. Then other person they will say they new entrance, they will not come together to form a new firm because already their cost is high. If there is a new firm, their cost will be high, they will not get the profit, then they are not show the interest in entering into here. So this is the main problem. Next, oligopolies may collude with rivals and rise price together, and after that when the new entrance, when the competitor is not there, he will increase the price, and but may attract new entrants also. Here cost plus pricing is straightforward pricing method where a firm sets a price by calculating average production cost and then adding fixed market markup to achieve desired profit level. So what is the production cost, and add to the markup, add to the profit margin, and they will sell that. Fixed plus variable cost are calculated plus markup for profit and contribution pricing, where only variable costs are calculated with precision and markup is contribution to both fixed cost and profits. Next, non-price strategies. Non-price strategies. Here, non-price strategies is favored strategies for oligopolies, because price competition can lead to destructive price. For example, include here trying to improve quality after sales servicing, such as offering extended guarantees. They provide the extended guarantees. This is non-price strategies. We do not have involve direct prices. Here giving the guarantees and spending advertisement, sponsorship and product placements, and sales promotions such as buy one get one free is associated with large supermarkets, which is highly oligopolistic market dominated by 3 to 4 large chains. Next, loyalty schemes, which are common in the supermarket sector, such as Reliance One Card. Next, pricing policies. Pricing policies are the relative price structures should be here provide an incentives for adapting improved technology and maximization productions. Next, work toward better balance between demand and supply. Next, avoid adverse effect on the rest of the company, promote exports, encourage optimum utilization of resources. This is pricing policies, where principles of product pricing is price customization. What is the price customization? Here, customized keeping taste, preference and preserve values customer into consideration. Pricing customization is done in various ways, that is based on product line, based on customer past behavior, based on demographic, and based on time differentiation. So based on this, price will be customization. They will provide in customization. For example, if a requirement of consumer product can be customized and accordingly the price, somehow like smartphones with 16 GB over 32 GB. In this case, pricing of the product can be based on memory specifications. If you want more memory space, if you require to pay more amount. Next, based on customer past behavior, a customer with a good payment, if he is paying good payments good within a time, and we will give the more discounts than others. Next, based on demographics, some areas different pricing may be adapted based on age or social status, or for example railway fare concessions for senior citizens, or concessional price ticket for military personnel, etc. Next, based on time differentiation, pricing for product or service is also done on the basis of time or differential, that is different price for different time period. For example, discounted price for data usage provided by broadband service provider if subscription paid for 6 months at a time. It is time differentiation. If you paid within time, or if you paid before the time was arrived, then they will provide the vouchers. Next, price sensitivity. Price sensitivity means where if you are in a case, if the consumer behavior changes in price of a product, then it will be, there are 9 factors that contribute the price sensitivity, where the factors are unique value effect. Next, substitute awareness effect. Here we will see what is the unique value effect. What unique value effect means, more unique product, lower in price sensitivity. If you have any unique in your product and lower in price sensitivity. Next, substitute awareness. If the buyer are aware of substitute and this perform the same function, then buyer price sensitivity will be higher. For example, if you take we have Apple iPhone. If we see any other phone same like as Apple iPhone, which will be cost is less, then the price sensitivity will be increased, because he will see the in a price only, and he will compare the features. If the features are same, and why we go for Apple, we will go for this, they will think in that way. Next, difficulty comparison effect. That is, price sensitivity will be low if the buyer has difficulty comparing two alternatives. You do not have comparison between two items. If they see in the Apple phone and other phones, they will not any have comparison, then it is price sensitive will be low. You can buy in that price only what the Apple product Apple owner sells. Next, total expenditure effect. If then expenditure on the product represents a low proportion of the consumer income, the price sensitivity will be less visible of such a product. Next, end benefit effect. Buyers are less price sensitive where the expenditure on the product is low compared to the total cost of the end product. Next, standard cost effect. If the cost of product is shared by another party, the buyer will have less prone to price sensitivity. Next, sunk investment effect, where if you price sensitivity will be low. Sunk cost means it is a irrelevant cost. Even if you incur for that cost, it will be not impact your decision. Next, price quality effect. Higher perceived quality of product, lower price sensitivity. Next, inventory effect. If the product cannot be stored, the buyer will be the less price sensitive. Next, price sensitivity track both nature of product and buyer behavior to determine prices. Next, one of the method more commonly used for measuring price sensitivity is controlled experimentation. Then company brand services brand price are changed and customers responses at each price level is recorded. Next, pricing methods. We have for calculation of pricing we have different types of methods. There are three methods. Firstly, competition based and cost based and value based. In competition based we have going rate price and shield bid pricing, and we have for value based we have true economic value and perceived value. So for each method we will see the what is the formulas and what is the value, how we allocate the, how we calculate the value. Next, cost price pricing, cost based pricing method. Here simple, what is the your cost, what is the your cost, the estimated cost of production, and you will fix the margin. What is your cost plus you will add the margin, fix the margin, then it will be full cost at current output and wage levels since the regard most relevant price determinations. Here we have for total cost two limitations. What is there? When you are going for allocation for interdepartmental overheads is based on arbitrary basis, and allocation of overheads will require estimation of normal output which often cannot be done precisely. This is two limitations so far where we are going for cost based pricing method. Here only we will see the cost production plus profit margin add, but we go for inter department we will not add the profit margin, so that is the limitation. In order to avoid the complications, variable costs are considered relevant cost for that add up and used for pricing by adding markup to include fixed cost allocations. We will not include the fixed cost for internal departments, that is the limitation only. Next we will see the one illustration. They provided one illustration. In this illustration what is there? This is one company, Bosch is a one company. It has providing special product. Okay, the product have life cycle 5000 units, so it will provide 5000 units. Next, it is estimated that market can absorb first 500 units, so it is providing 5000 units, and from 5000 units 4.5 units will be 64 rupees. Sorry, for 5 we will see this 4500, it will be the 64. Remaining how many 500 units existing? What is the 500 units? And then product will enter into declining stage. So for 500 units it will go for declining product. Okay, direct labor will be 6 rupees per hour, and over other variable cost will be 19 rupees per hour, and fixed cost will be 40,000 over life of product. So it was provided for total 5000 units related expenditure, but its sale value was 64 rupees for 4500. They don't know about 500 units cost value price. Next, the labor rate and both of these costs will not change throughout the product life cycle. Next, the first batch of 100 units will take 1000 labor hours. So for we have 5000 units for the first batch. Each batch we will provide 100 units. For 100 units we have 1000 labor hours to produce. Next, there will be a 80% leaning time. There will be a 80% leaning curve that will be continue until 2500 units. So up to 2500 units it will be 80% leaning curve will be applied, and after that have been produced. Next, batch after this level will each take same amount of time from 25th batch. So after 25th batch it will be take same amount of time. The batch size will always be 100 units. So for 5000 units, how many batches will be provided? 5000 into 100, 5000 divided by 100, so 50 batches is there. For 50 batches, up to 24 batches, we have the time they provided, average time they provided for that. And for 25th batch to remaining 50 batches, for 25th batch to remaining 50 batches, there will be same time. So that we will calculate what is the selling price for average selling price for total units required. Next, they provided calculate average selling price of final 500 units that will allow the company to earn total profit will be 80,000. So they provided the desired profit will be 80,000. So for 44,500 units value price was provided, 500 units value they are not provided. Remaining 500 units value we need to find out, and for that we need profit will be the 80,000. So and for all expenditure cost was provided there itself. Next, we will see that. Next, what is the provided? If average time will be 24 batches is 359.4. For 24 batches they provided 359.4 hours. Here learning coefficient is 0.322 for learning rate 80%. Okay, the value of logs have been given for calculation purpose. Log 2 provided, log 3 provided, log 5 provided, and anti-log provided, anti-log off provided. So they provided the log values. Log values will be useful for calculation of average time, and where there is a cumulative average time we will exist. Okay, next, average selling price. We will what is they have for final 500 units we will to calculate. What is they provided? For direct labor they are provided that for 24 batches 24 into 359.4 24 into 359.4 we will get the 362. Okay. For first batch we will get the 362 whatever the amount will become through 24 into 359.4 we will get the 8625.6 8624.5. This is only 24 batch plus we want one batch, that is 25th batch we are required. So we will calculate for 25th batch, then we will here they will put for 25th batch. What is the 25th batch? It will be the value we will calculate. Okay, next, plus for 25th batch. Next, into 25th batch for remaining 25th batches. For remaining 25 batches we will calculate 24 plus year 1 and remaining 25 batches into what is the labor cost. Labor cost will be 6 rupees. We will into the multiplier. Next, 19 rupees for total 5000 units. We will take directly. That is 5,000 units into 95,000 will be the cost. Next, they provided fixed cost directly. Fixed cost will be the 40,000 and total life cycle cost will be, and they provided diesel profit. What is the diesel profit they want? 80,000. So 80,000 we will take here 80,000. So expected sale value will be 3,04,490. This is for total 5,000 units. Total 5,000 units. Here we provided for 4,500 units sale value, that is 4,500 into 64, we will get the 2,88,000 for now. Next, sale value will be 16,490. Sales units will be 500. Sales unit will be 500 and average sale price per unit will be 32.98. This is the case. Now what we required is this values. These values we require to these values. How they calculated? When they provided the learning curve model. Here we will see that average cumulative average time per batch for first 25 batches. First 25 batches, what is there? We will learn the formula y is equal to ax to the power of b. Y is equal to ax power of b. Here y is equal to average time per batch. So what is the average time is there? For 100 units we will take the I think we will take 1000 hours. See, 100 here they will provide. See, for a year, for 100 units we will take the labor hours. So average time will be what is the average time? We have 1000 hours. Okay, 1000 hours into a into x to the power of b. What is the x? Batch. Which batch we are taking? 25th for 25th batches. For first 25th batches. So 1000 into 25. Next, to the power of, here we will see 25th batches time required for first batches. Next, x will be cumulative number of batches produced. How much cumulative batches you are produced? How much cumulative batches you are produced? Based on that we will calculate how much we will produce. 0.322. How we will get this 0.322? It has some other calculations. So we will get this. For that we will take into log for both. For log, when you take in the log, it will become log 1000. It will come into front of 25 and it will be 0.322 into log 25 and log 1000. And here where if you don't know the how we will take, if you take log a into b, then it will become log a plus log b. And if it is a log a to the power of b, then it will become b log a. It is the case in where if you have a logs. And here we will get log y is equal to, then we will get the log y value will be the 354.70. and where we will get the anti-lag. This anti-lag value we provided in question itself. Next, total time taken for 25th batches. For the total time for first 25th batches will be 354.7 hours into 25 batches. 357 hours into 24 batches, where 8,867.5. and for first batches they are provided in question itself 359.4 hours into 24. So from that we will reduce the amount, then we will get the what is the value 8,867.5 minus 8,625.6 hours, that is 241.9 hours. This is the case of cost plus that value. Next, competition based pricing method. Here competition based pricing method that is going rate. Now what we missed, if anyone we missed, for first 25th batches how we calculated that 257? Just 2 seconds. Oh, just 2 seconds. I will calculate it.